Hi, I'm Liz. If you're like most people, you've worked hard, and you've managed to stash some cash away in your sock drawer. Or your bank, which, well, let's face it, might as well be your sock drawer with all that interest it's earning. You'd like to invest your money and secure that financial freedom you deserve, but you don't want to pay some broker fat fees to babysit your money, and you're a little nervous to invest it yourself because you're afraid you might lose your shirt. But that's where I come in. Today, I'm going to show you how to take that cash out of your socks and put it into some stocks. I'll show you how to create a broadly diversified portfolio using the latest investing theories the pros use in just a few minutes. I mean, investing doesn't have to be complicated, especially not with me on your side. So, let's get started. At its very simplest, investing is a two-step process. First, you need to decide what kind of investor you are. A growth investor, a balance investor, or maybe an income investor. Once you get that down, I'll show you a typical portfolio that may work for the level of risk that you're willing to take. Growth investors, they're like the adrenaline junkies of the investing world. They've got nothing but time, and they're primarily looking for long-term growth of their investments. But this growth can come at a cost. Over a recent 12-year period, a typical growth portfolio averaged about 10%, with its best year up 27%, and its worst year down 17%. So growth investors need to be willing to ride the waves and tolerate a short-term downside for a possible bigger upside. Balance investors, they're like the cool, I'm in no hurry, but I'm no Evel Knievel either types. They're a little more conservative than a growth investor, but they still want to benefit from that long-term growth. They're primarily looking to reduce market volatility by including some income-generating investments in their portfolio. And in exchange, they accept moderate growth. Income investors are like the slow and steady wins the race types. They typically have a very short time horizon, a low tolerance for risk, or possibly both. They aim for modest growth of their investments while generating income at the same time. Now take a quiet moment to yourself and decide, what kind of investor are you? Go ahead, push pause, I'm not going anywhere. Moving on. Now that you've connected with your inner investing child and you know how you want to invest, you need to decide what you want to invest in. I know, there's so many ways to invest your money. It's easy to get overwhelmed. But don't. In just 3 buys, you can build a diversified portfolio using exchange-traded funds, or ETFs. ETFs track broad indexes or asset classes like domestic stocks, international stocks, and bonds. So you could simply purchase one ETF per asset class. How hot is that? Now the portfolios I'm about to show you are only examples. Okay, adrenaline junkies, here's a typical target portfolio for growth investors. Since you've got nothing but time and money, lucky dogs, and you're willing to take the risk, you can invest 69% of your money in a domestic total market ETF, 13% in an international stock ETF, and 8% in a bond ETF, with the rest in cash and savings. I mean, you're gonna need something on hand for that skydiving trip you've been planning. For a balance investor, a typical target portfolio is 49% in domestic stocks, 12% in international stocks, 18% in bonds, with the rest in cash and savings. To get into a portfolio like this, you could simply purchase 3 ETFs, 1 per asset class, just like before, and voila, you're in the market, baby. For our conservative income investors, a typical target portfolio breaks down like this: 31% in domestic stocks, 6% in international stocks, 34% in bonds, and 29% in cold hard cash for the hip replacement. Just kidding. And just like the other 2, you can get into this portfolio with just 3 buys. Now, I'm not telling you this is what you should do. I'm simply showing you a few ways you could allocate a portfolio based on a level of risk you're comfortable with. You've got to use your own noggin. Figure out what works for you. See? Investing doesn't need to be complicated. We just use techniques rooted in modern portfolio theory to easily build a diversified portfolio. Thanks for joining me.